Less than 2 months, a move of over 50%. What does that actually mean? From the May first buy signal to today, Credo Technology Group has delivered a 54% gain in just around 2 months. This trade originated from the Arakawa Quant intelligent multi-factor screening model in early May. The system identified a clear mispricing between accelerating AI compute infrastructure demand and market valuation. Today, we'll break down the original stock selection logic behind this move. The core fundamental driver was the over $700 billion in AI capital expenditure planned by major hyperscalers. Within large-scale compute clusters, low-latency, high-bandwidth interconnects between GPU become a hard infrastructure constraint. Credo's SerDes chips and active electrical cables, AEC, directly address bottlenecks in power efficiency and data transmission. At the same time, the market largely overlooked a key catalyst: Credo's acquisition of DustPhotonics, which brought silicon-photonics into its product stack. This extended its exposure into the 800G and future 1.6T optical interconnect cycle. At the time, a major concern among investors was forward P/E compression risk. However, after adjusting for growth, the model-derived forward P/E/G was approximately 0.45, implying a significant valuation discount versus peers, roughly 69% below the sector median. Revenue growth expectations were around 130%, with EBITDA growth projected near 315%. Profitability grade improved from B- to A- within 6 months. Meanwhile, analyst revisions turned strongly positive: 14 EPS upgrades and 13 revenue upgrades over 3 months, with 0 downgrades. A textbook, multi-factor positive revision cycle. Following the latest earnings release, Credo delivered its strongest quarterly and full-year performance to date. Quarterly revenue reached $437 million, exceeding the prior full-year revenue in a single quarter. Full-year revenue grew 205.7% year-over-year to $1.34 billion. On profitability, non-GAAP gross margin expanded to 68.3%, above the high end of guidance. Net income surged from $52.18 million to $472 million, with diluted EPS at 1.16, beating consensus estimates by 13.7%. This outcome effectively validates the low P/E/G revision-driven setup. Beyond financial performance, the DustPhotonics acquisition completed at the end of May. This move finalized Credo's vertical integration across SerDes, DSP, and silicon-photonics technologies. Management guidance indicates that silicon-photonics, zero-flap, optical devices, and standalone optical DSP products could each contribute over $100 million in annual revenue in the next fiscal year. In parallel, adoption of its zero-flap AEC solutions is accelerating among hyperscale cloud providers, driven by improvements in reliability and power efficiency, which increases visibility on future order flow. The company also holds approximately $1.4 billion in cash and equivalents, providing strong balance sheet flexibility. From the May 1st model signal to the late May acquisition close to the June earnings beat, this sequence demonstrates how a multi-factor quantitative system can position ahead of major inflection points. In volatile macro environments, the key remains consistent. Identify high-growth names where valuation remains attractive even after adjusting for growth.